Let's review chapters 5 through 9 and 11. We're first going to talk about merchandising operations. And we're going to talk about the journal entries from the seller's point of view here when they're making this sale. So it says that Summer Company sold $1,000 of merchandise to Wilkes Company, FOB shipping point, terms 210, net 30. The goods cost Summer Company $650. So from the seller's point of view, there's going to be two different journal entries here. First, we need to record the selling price, what we are charging our customer. So we will debit accounts receivable, credit sales revenue for that full $1,000. But then we also want to show what these goods cost us, the seller. And so that's where the second entry comes in, a debit to cost of goods sold and a credit to inventory. And remember, your cost of goods sold account is an expense account. Now, let's break down all of the pieces that were given to us here, starting with FOB shipping point. That tells us who has to pay for the shipping costs. So when it's FOB shipping point, the buyer has to pay for all of the shipping. If it's FOB destination, then the seller would pay for the shipping. Next, we have these terms, right? We read this as terms 210 net 30. What that means is that the seller's willing to offer a 2% discount if the buyer pays within 10 days. Or they have to pay the net, they have to pay all of it within 30 days. So that 2 represents the potential discount, 2%. The 10 is how many days they have to pay back Summer Company in order to get that discount. Or they have to pay the net, they have to pay everything that they owe within 30 days. The next chapter touched on perpetual inventory. So when we learned about perpetual inventory, that's when we talked about FIFO, LIFO, and average cost. Right? It's all about the movement of the inventory that we have and how we are going to figure out what our cost of goods sold and our ending inventory will be using these 3 different methods. So FIFO is first in, first out. FIFO is going to give us the lowest cost of goods sold amount among these 3 different methods. And a lower cost of goods sold amount means a higher net income under the FIFO method. LIFO is last in, first out. So the last piece of inventory that you just purchased is going to be the first one that you sell. And under LIFO, we have a higher cost of goods sold, which will bring down our income. So a company would be interested in this setup because lower net income means lower taxes, right? So there's pros and cons for both FIFO and LIFO. Average cost is just going to be somewhere between our FIFO and our LIFO numbers. So the cost of goods sold isn't going to be as high as what we get when we use LIFO, but it's also not going to be as low as we get when we use FIFO. Now, a company is going to pick one of these methods and stick with it. Because in order to change, they have to go back multiple years and redo all of their financial statements, and it's a lot of work, right? So they're going to pick one method and they're going to stick with that for a good amount of time. Chapter 7 brought up our special journals. So we have a few different special journals that we need to remember. We have our sales journal, purchases journal, cash receipts, and cash payments. And then if it doesn't fit in any of those 4, then we just record the transaction in the general journal. So we have a list of transactions that we're going to go through and figure out which special journal they fall in. So our first one, we have cash sales. So the first question that I want you to ask yourself whenever you're working through special journals is we need to ask, is cash involved? Because if cash is involved in this transaction, that means that it's either going to go into the cash receipts journal or the cash payments journal. We can eliminate all of the others. Here we see the word cash. So we know it's either cash receipts or cash payments. Then we think about what's happening with this cash. Well, we are making sales. So if we make sales and are getting cash, that will fall into the cash receipts journal. So whenever you are receiving cash, we put that transaction into our cash receipts journal. Our next one, credit sale of merchandise. So whenever you have a sale of merchandise on account or a credit sale of that merchandise, that is the definition of what will fall under the sales journal. Now notice, we didn't put cash sales under the sales journal because for it to go into the sales journal, it needs to be a sale of merchandise and on account. It has to fit all of those criteria. So that one goes into our sales journal. Next one, owner withdraws cash. So we see that word cash again. So we can eliminate the sales journal, the purchases journal, and the general journal. We know that it's either cash receipts or cash payments. And we need to remember that while we're doing this, we are the company. We are not the owner. So the owner is getting money, right? They're withdrawing cash from the business. They're getting that cash. But from the business perspective, the business is losing cash. They are paying out that cash to the owner. So this falls under the cash payments journal. Our next one, purchase of merchandise on account. This is, once again, the definition of what goes into the purchases journal. So the purchases journal and the sales journal are somewhat related to each other, right? The sales journal earlier was the sale of merchandise on account, while the purchases journal is the purchase of merchandise on account. And again, it needs to check all of those boxes. It needs to be a purchase, it needs to be of merchandise, and it needs to be on account. If it matches all three, then it goes into the purchases journal. Now our cash purchase of land. And once again, we see the word cash. So we know it's either cash receipts or cash payments. If we are buying land, that means that we have to pay money. So if we're paying money, this will go into the cash payments journal. Now, we see also the word purchase, right? So why not the purchases journal? Well, it doesn't match really any of the other criteria, right? This is a purchase of land with cash. Land is not merchandise, and cash is not on account. So, even if this was a purchase of land on account, it still would not fall under our purchases journal. Our last one here, equipment depreciates. So we ask ourselves, is cash involved? The answer is no, right? The journal entry, whenever equipment depreciated, was a debit to our depreciation expense and a credit to our accumulated depreciation. There is no cash there. So we can eliminate cash receipts and cash payments. Then we ask ourselves, is it a sale of merchandise on account? No. Is it a purchase of merchandise on account? No. So it doesn't fall under the sales journal or the purchases journal either. Your equipment depreciating will go into the general journal. Now, another way to remember this is that you record your depreciation as an adjusting entry. And the general journal is where we will put all of our adjusting entries, correcting entries, and our closing entries. So adjusting, correcting, and closing all will fall under the general journal. Chapter 8 rolled around and we learned about bank reconciliation. So bank reconciliation is when we want to make the cash balance on our bank statement match what we have for our cash on our books, right, in our ledger. So this problem here says that Terry Davidson is unable to reconcile the bank balance at May 31st. So we need to fix the errors in Davidson's reconciliation below. So all of the numbers attached to the pieces are correct. The cash balance per bank is that $3,560. The NSF check is $490. The problem is that Terry put things in the wrong spots. So we're going to start off with just this framework. And we can see that when we do a bank reconciliation, we start off with our per bank, and then we list out our per books. Starting with per bank, we will begin with the cash balance per bank. That's what is on our bank statement when we receive that. So that's that $3,560. Then we need to think about, okay, what gets added to the per bank side? Well, Terry Davidson over here incorrectly added the NSF check. That's not going to go there. So we have to think about, from these different adjustments that we are given, what would go under the per bank side? Well, an NSF check is a per book adjustment, and a bank service charge is also a per book adjustment. So then we look down below and we see deposits in transit and outstanding checks. Those are both adjustments that we make on the per bank side of a bank reconciliation. So one's going to need to be added and one's going to need to be subtracted here. So we need to think about which one goes where. A deposit in transit is when we have sent money to be deposited into our bank account, but it just hasn't gotten through to the bank yet. So a deposit in transit is going to increase the balance in your bank account. So we have to add that deposit in transit here. Outstanding checks are checks that we have written that the people that we wrote them to just haven't taken them to the bank yet. Right? So there's no way for the bank to even know that you wrote someone a check. But once those checks are taken to the bank, that's going to take money out of your bank account. So we subtract out our outstanding checks. Then we need to find our adjusted cash balance per bank. So we start off with our $3,560 for our cash balance, add in our deposits in transit, subtract out the outstanding checks, and we see that the adjusted cash balance per bank is $3,360.20. So then we can move down to the per book side. And we have two adjustments left, right? We have the NSF check and the bank service charge. So we first think about the NSF check. The NSF check is a bounced check. It's not sufficient funds, right? So this is when a customer pays you for your work. So we got a check of $490. We make the assumption that that customer has that money. So we say, yep, our cash is going up by $490. But then the bank comes back to us and tells us that check bounced. There wasn't money to clear that $490. So an NSF check has to be subtracted out of our cash balance per books because we never actually received that $490. Then we look at the bank service charge. A bank service charge is when a bank charges you for either just like a monthly fee, or maybe there's some type of check printing charge, right? Some kind of fee or expense from the bank itself. Here it was $25. Well, they aren't going to be giving you that money. They're going to be taking that money away from you, right? So in this example, we don't have anything that we're going to add to our per book side. Instead, we have two things that we're going to subtract. So once we have both of those in, we then need to find the adjusted cash balance per books. So we start off with our initial cash balance per books, the $38.75. Subtract out the NSF check of $490. Subtract out the bank service charge of $25. And we see that the adjusted cash balance per books is $3,360.20. And where have we seen that before? Up in our adjusted cash balance per bank. Those two amounts have to equal each other. That is why we are doing this bank reconciliation, is because we want our adjusted cash balance per bank to equal the adjusted cash balance per books. Then Chapter 9 came along and we learned about the allowance method, a way for us to estimate uncollectible amounts. So we're told here that the ledger of Preston Company at the end of the year shows accounts receivable of $175,000, sales revenue of $550,000, and sales returns and allowances of $35,000. If allowance for doubtful accounts has a credit balance of $2,100 in the trial balance, we need to journalize the adjusting entries at December 31st, assuming bad debts are expected to be 1% of net sales. And then we're going to do this all over again, assuming our bad debts are expected to be 10% of accounts receivable. So under the allowance method, you can either do the percentage of sales basis or the percentage of receivables basis. So we're going to start off with this percentage of sales. So we're assuming that our bad debts are expected to be 1% of net sales. Well, before we can even figure out what 1% of net sales is, we need to figure out just first, what's our net sales? Because we aren't given that amount. So your net sales would be your sales revenue minus your sales returns and allowances. And we could also subtract any sales discounts that we have in here. So we subtract the $35,000 from the $550,000, and we see that our net sales are $515,000. So that's step one. Now we can figure out what 1% of that is. So we take the $515,000, we multiply it by 1%, or 0.01, and 1% of our net sales is $5,150. Now we have some information that we can use when we are needing to journalize this adjusting entry. So under the allowance method, whenever we estimate uncollectibles, we will debit bad debt expense and credit allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset. Just like how your accumulated depreciation went against your equipment on a balance sheet, your allowance for doubtful accounts would go against your accounts receivable on a balance sheet. Now, we need to figure out our number here for this journal entry. We have our 1% of net sales, but then we might also remember having to use that credit balance of the $2,100. That balance in allowance for doubtful accounts that we started off with, the 2100, that comes into play when we are doing percentage of receivables. When we are just taking a percentage of our sales here, the 1% of net sales, all we need to do is toss that 5150 into the journal entry. We don't even need to worry about the beginning balance in your allowance for doubtful accounts. Now, let's do all of this for part 2, where we are expecting our bad debts to be 10% of our accounts receivable. So, first step, we need to figure out what 10% of our accounts receivable comes out to. So we take the 175,000, multiply it by 10%, and we get this 17,500. Now we need to take into consideration that beginning balance in allowance for doubtful accounts. So we make a T account, and we put that beginning balance in for allowance for doubtful accounts. And then we put in this ending balance, this 10% amount that we just found. So we know that we want to go from 2,100 on the credit side to an ending credit balance of 17,500. This entry that we're about to journalize is for whatever that number would be in that red circle. It's to adjust your allowance for doubtful accounts from 2,100 to this new ending balance of 17,500. So the way that we find that number is we subtract 17,500 minus 2,100, and we see that that's 15,400. Now we can talk about the journal entry. It's the same framework. Bad debt expense is debited, allowance for doubtful accounts is credited for the 15,400 that we just solved for. Then in chapter 11, you learn some stuff about payroll and a few pieces here that we're going to talk about with payroll. First, the difference between gross earnings and net pay. So gross earnings is the total amount earned by the employee. Think of that as the hours worked times the hourly wage. So if you work 40 hours a week at $20 an hour, you multiply those two together and you can find your gross earnings for that week. But your gross earnings isn't necessarily your net pay, right? Because your net pay is the amount that you're actually going to be receiving. And so that's going to take out any kind of deductions. So any kind of taxes, any kind of union dues, health insurance, any kind of deductions get subtracted out from your gross earnings in order to find your net pay. So the net pay is the amount of money that's actually on that paycheck. That's the net pay for the employee. So your net pay is going to be less than the gross earnings for that employee. Now, one of those deductions is FICA taxes. So we're told FICA tax has this percentage of 7.65%. That percentage comes from somewhere. It comes from a 6.2% tax and a 1.45% tax. The 6.2%, that has to do with Social Security. Now, what's special about this tax is that there's a certain limit. An employee can only be taxed for Social Security up to the point of making $127,200 in a year. Once they make more than that, any amount higher than that $127,200 threshold is no longer being taxed by this 6.2%. So there's this certain limit that someone would have to pay into for Social Security. Now the other piece of FICA, that 1.45%, that's Medicare. Medicare, there is no limit. You could make $1 billion in a year and still be having to pay into Medicare. So remember that FICA tax rate, that 7.65, is made up of these two different pieces, and we have this limit for Social Security, but we do not have a limit for Medicare.